Um, uh, Jacob, we've got a lower tier. For those who don't have the capital, we've got a lower tier. It's free. The lower tier is free. You can't get cheaper than that. Have a look at all the free stuff at campaignforamillion.com. We have 2 tiers, membership and zero. I can't get cheaper than zero. So yeah, absolutely. And I do the free webinars. The books you can download for free as well. They get the book for free as well. Any questions, let me know. Thoughts on Meta? I covered that earlier. It's volatile. I continue holding it. I don't panic. I don't get bored. SJP charged me 2.5%, grew my pension by 2.5% per annum for 7 years. They're appalling. St. James's Place are absolutely bloody appalling. And they get paid a lot of money for people who work for them to pretend that they're not rubbish. Okay. Thank you, Jacob. As well. Thank you, everyone else. Now, we got somebody from Washington on here earlier, so thank you for that. Thoughts on Apple and Amazon into the earnings? Jacob, that would be trading. I hold them. I have no problems holding them. Everything else is noise. And that's the attitude. If they fall, I might buy more. I couldn't care less what happens going into earnings. I'm not trading earnings. Even when I'm trading, I'm not trading around earnings. It's just a gamble. Retail clients love it. Brokers love earnings because it gives them an opportunity for people to panic. What does Warren Buffett say about earnings? Ignore them. Ignore them. Okay? As well. All right? So that's the thing. I'm going to roughly go backwards on the various slides on here. What am I missing? There's something I just saw something. Here we go. Thank you. Supermicro is, I think, incredibly volatile, isn't it? If you like the volatility of Supermicro is fine as long as you've got a portfolio. Let me explain something on portfolios. I'm going to show you something. I don't know if you can see where I am because I'm quite small on the images. If you've got 2 stocks, both averaging, let's say, 15% per annum, so they're not even NVIDIA, they're just mediocre companies averaging 15% per annum. And you might think, well, which shitty companies are doing that? But just assume they both do. And one of them goes up when the other one falls, but they both average 15% per annum. Then at the end of the year, if you only picked any one of those, you'd have some volatility and a 15% return. Okay, but if you put both together, because one went up when the other one fell, but they both generate 15% per annum, you'd have 0 volatility and a 15% return. So by adding 2 risky assets, which were moving inversely to each other, but both averaging 15%, you manage to get the same return for less volatility, i.e. same return, less risk. Harry Markowitz and